Welcome to Darin Batchelder's Real Estate Investing Show. Each week, you will learn how to grow your wealth through real estate investing. Be introduced to the players that are getting it done and learn how you can get involved. And now, here's your host, Darin Batchelder.
Hello, everyone. Today we have a very special guest with us today. We've got Michael Becker. Michael, I appreciate you coming on the show today.
Hey, Darin, thanks for having me on. Appreciate the opportunity.
Absolutely. So just a little bit on how I know Mr. Michael Becker before we get started. So I only got involved in multifamily about 3 years ago. And when I did get involved, I started listening to a lot of podcasts. And the three that I kind of focused on was Old Capital, Rod Khleif, and Joe Fairless. And Michael Becker is on a lot of the Old Capital podcasts, so I was able to benefit from his knowledge. And then when I joined a multifamily mentorship group, I just had a lot of people that would bring up his name as being just a leader in the space, both living in Dallas. He's really grown his market in the multifamily space and his reputation. So very, very happy to have him on today and share with the listeners. So with that, Michael, just start out with, can you share how many properties and how many units you're currently invested in?
Currently, I should know this a little bit better. We bought a deal this week, so I think that's like 25 or 26 in the portfolio today. We've done 50-ish, maybe a little bit more than that. So we've done a little bit over 10,000 units. We have about 6,000 units today, and thanks for the nice words. It's kind of funny when you get into this business. You have a podcast or show, and it's kind of funny. When we started out, we had dozens and dozens of listeners, and now we get 40, 50,000 downloads a month on the show. And you go to some of these events, and it's not, my life isn't quite what I thought. 18-year-old Michael Becker didn't think his life would be quite like this. I thought I'd have like good-looking 20-year-old blonde girls hanging out with me. And that is like 50-year-old middle-aged guys that think I'm kind of cool. So a little
that's funny,
but I'll take it.
Yeah, that's hilarious. So, I could imagine you show up at a conference and you meet somebody for the first time and you don't really know much about them, but because they've listened to so many of your shows, they feel like they know you. And so that's got to be is kind of a weird situation for you.
Yeah, I'll tell a funny story. I was at a dinner, Plano, not too far from where you're at. We go to have dinner with my in-laws and my wife's uncle and his wife, and so we go to Roy's, the Hawaiian place in Plano, and I'm sitting down, and some guy comes over to me and he's like, "Are you Michael Becker?" And he listened to the show. My wife was all embarrassed because that's happening in front of her mom and her uncle, and so it's just kind of funny how that is. So I'm a minor celebrity in a very, very small niche. You get me out of this, and it's funny how guys like you are excited to talk to me, but you go home and no one cares about any of that stuff when you get walking.
You go to the grocery store, they leave you alone, but you go to a multifamily conference and they're all over you.
or you walk in your own house. No one seems to care that all the stuff you call.
Especially the kids. I don't know how old your kids are, but I've got two teenagers, and once they turned into the teenage realm, forget about anything that comes out of my mouth doesn't make sense. So. Hey, I think that it'd be great if you could share a little bit about your story, because there's a lot of listeners and there's a lot of people who get into the multifamily field that they come in and they're working a W-2 job and they hear that there's large wealth opportunities in multifamily, but they don't really know how to make that transition So I think you have an awesome story. So if you could just share a little bit about that, that'd be great.
Yeah. As you mentioned, so I'm based in Dallas. Grew up in the area. Went to college at University of North Texas. So kind of stayed in the general area my entire life, really. And I'm kind of in my early 40s now. So I cut my teeth kind of early 2000s, and so I got my professional career really was in banking. That's kind of what I did. Worked my way through school. Kind of one of my little jokes I like to say is, I was in college for a long time, so I ended up working working kind of full time, going to night school the last part of it. So my joke is I beat Tommy Boy by a year. I was in college for 8 years. I'm not a doctor, so had a good time, and then finally kind of got serious and realized I didn't want to be the guy that goes to college for 7 years and doesn't graduate. So I finally got my stuff together, graduated, and then I was working at the bank. So I got into the credit department. Coming out of it, I was kind of the retail side and got in the credit department, and that's kind of really where I learned how business actually happened, was kind of just underwriting a bunch of loans. And so I worked for a bank that we did a lot of commercial real estate lending, and did that for 2.5 years, and then got promoted into the production side, so became a loan officer. And then the first couple of years of my career were great. You couldn't make a bad loan, Darin. I mean, everything just was going up, and then one day that all changed. In 2008, that just kind of overnight just changed. And I go from making a bunch of loans to doing a lot of problem loan workout. So all these loans that were good when we made them quickly didn't turn out very well, and so that was a really tough time, but it was a great learning experience. I got to and through that process, my bank actually got purchased by Wells Fargo. So I ended up going to Wells Fargo and kind of hid out for several years there. And it was, a valuable lesson to see, all these kind of optimistic things that everyone had back in 2006 and 2005, and how that turned out to be a little bit different when they just weren't fundamentally set up. And how do you actually work these deals out and collect your money, and have some very difficult conversations with a lot of people. And fortunately, I had a paycheck throughout all that, so I didn't have to worry about keeping the lights on and things like that. And then coming out of the Great Recession, really, I kind of going into it, I made loans on all the various kind of income-producing asset classes, commercial real estate. Also did some land loans and development loans, but have experience loaning on office, industrial, retail. But coming out of the Great Recession, really the only thing that was working was multifamily. So I was like, okay, well let's work on that, because I did some of that kind of going into 2008, and then kind of built a program out. Got in a real good groove with Paul Peoples, who's kind of the co-host of the Old Capital podcast, and he's my biggest referral source when I worked at Wells Fargo. And I probably did, in about a 3-year period, did about 150 loans on apartment buildings, and we're just kind of making a bridge loan, taking all these broken properties coming out of the recession, give them a bridge loan to reset them and kind of fix them up, kind of, as Paul would call it, like a Humpty Dumpty loan. It's kind of broken, you got to put it back together and get it going. So probably the 150 loans, probably nearly 100 of those were kind of through Paul. So we just did a ton of deals. And then in that process too, I kind of just realized, making all these loans to all these people, and I was making a good living, but all my clients were kind of getting rich. And in particular at the time, there was a group which is still around called Lifestyles Unlimited. So I did a lot of loans to those people, and that's where I know you're a member of Sunrock's group. So Brad was kind of running the Dallas office, and that's where I kind of got to know Brad, because he was the head of the Dallas office at the time. And it's kind of watching those guys and just realizing, I was like, a lot of these guys weren't any smarter than me, or a lot of them didn't have as much money as I did, because I was always a good boy and lived below my means and saved my money and things like that. So I started out about a decade ago buying some smaller stuff, some single family houses, and that was good. It's probably unnecessary with the benefit of hindsight, but allowed me to kind of get some real world project management experiences, running and fixing these broken properties on a small scale and using my own money. And then did that for a couple of years. That wasn't very scalable, because I was really busy at work, and I had a wife and 2 kids and 16 rent houses. So I decided one day, let's transition
16 rent houses. Wow.
Yeah, one at a time. It's kind of one after another. 2 months I was buying, renovating, leasing it out, refinancing, and like repeating. It was basically every other month I was doing one for about 2 years. And then so I decided to get into multifamily. So 2013, we bought our first deal. It's a 120-unit deal in Garland, Texas, so like eastern suburb of Dallas. And it was built in 74, I think it was. And we paid like $3.8 or $3.9 million. So if you do that math, that's kind of 30-ish thousand a unit. And then we owned that for about.
It's not like that anymore.
Yeah, I owned it for about 2.5 years and sold it for about $6.4 million, I think. So about 55,000 a unit. Then the guy sold it for 80,000 a unit, and it's probably worth 100,000 a unit today. Something like that. And then 10,000 units later, and the Old Capital podcast. I started a new show, the Multifamily Investing Show, Michael Becker, on YouTube or iTunes, and that's kind of what I spent a bunch of time on. So all that later, here we are talking to you.
That's awesome. You said a lot of things there, man. One is, there's a lot of people that just, they want to figure out a way to get into the investing game, and some people start in single family, some people go right to multifamily. Some people analyze, and they can never get off the fence. So, first talk about just kind of the fear of doing your first deal. Even, I've talked to a lot of investors that are, have thousands of units, and they maybe started with a single family, and that single family may have been one of their more fearful transactions because they didn't have the confidence and didn't have the process down yet. Yeah. So, when did you have fear? One, I guess, did you start investing while you were still at the bank?
Yeah, so I did all these homes. So at the time, you could buy. I think the first house I bought was a 3-bed, 2-bath house in 2010 or 11. It was $75,000 or something like that, and I put $10,000 or $15,000 in it, and I leased it out for $1,100 a month. So it was like $15,000 out of pocket. So that was a good bite size. I was like, all right, if I lost $15,000, it would suck, but it wasn't like going to bankrupt me. I wasn't going to be on the street. That's kind of how I got myself. And then, my wife kind of was obviously fearful as well. And it was a lot easier to say you're going to do something like that at the time than actually doing it, because you weren't sure if we're going to go right back in the Great Recession. It was still kind of choppy out in the marketplace, but it felt like a good time. And then, made about $500 a month in cash flow off that deal. Then I did the next one. So at the time, you can make about $500 on these houses in cash flow. So then my goal was I wanted to get $10,000 in cash flow. So I was like, I got to do 20 houses, right? So then I started doing all this work, and it was a lot of work, and I was managing it, and I was like, that's a dumb goal. I was like, I shouldn't have that goal. I need to kind of modify it. So I got to about 16 and realized, okay, that's counterproductive. And so I decided to kind of transition in 2013 and really use what I was using, because I'm looking at all these guys. I know you had he's a friend of mine too, Aaron Katz, on a few episodes ago, and I made him his first loan, right? So, like, I remember distinctly.
Did you really? Right.
Yeah, he walked in. It was at Paul's People's old office, and he had one Tuesday night or something. He did a little meeting in his office, a conference room, and had 10 prospective investors. And Paul and I were there talking about how do you put these loans together. And there's Aaron Katz, a mattress salesman, trying to put a deal together. And I'm like, I see him, and then I distinctly remember towards the end, before I decided to make the transition, there was one of the guys in Lifestyles. There was like two guys together, and one of them had a good job, and the other one was like literally a bus driver. Like, he drove a bus for a living and made like $40,000 a year. And he and another guy were going to buy a $1 million+ deal, and I was going to give them $1 million loan. I was thinking to myself, like, what am I doing? Bus driver's buying $1 million deal, and I'm sitting here at the bank, and I'm giving them a loan, what am I doing? So that kind of just got me going. So the first 4 deals I did, 800 units, were in about a 6-month period, and I did that while I was still employed. And then I was like, all right, I still had most of the houses. I had these 4 deals. I kind of had proof of concept. It was time to go. So as a banker, you're kind of bred to be a little bit more conservative. So I had to kind of take little steps and be a little bit more measured. If I would have just really gone out and just gone for it, like in 2011 on the multifamily, probably could have. I would have been, instead of Michael Becker, I would have been David Moore and Nightvest. I have 25,000 units instead of 10,000 units. But I don't have too many regrets or too many complaints. It's been a good run.
That's huge. So, one of the things you did was you took action getting the single family units. Once you started building that up, you said you had the wrong goal. So, between seeing the guys come in, the Lifestyles guys, Aaron Katz, other people, and also I'm guessing, your relationship with Paul at Old Capital and just talking to other people, at some point it clicked to you that, hey, I should start doing these single families and I should focus on multifamily. Is that kind of how
it was just a lot more scalable and so using all your own money. Obviously you leverage other people's money, you get non-recourse debt, you do these bigger deals, you can leverage a management company more efficiently. So it was a much more scalable business. I don't know if it'd be interesting as hypotheticals, you never know, but if I just would have kept on the trajectory, I would have had built out a company. If I was kept doing single family homes, I probably would have had I don't know, 1,000 houses or something at this point. And I don't know, maybe I would have been better off financially doing that versus what I did. It's worked out well, obviously. I don't have too many regrets, but maybe there's no right or wrong, I guess, in this business. Whatever kind of works for you.
No, but I think that some of the things that are learning lessons for people that are listening is, depending on where your mindset is, at some point, you need to be able to take action. And some people can't go. I've seen people, bypass single family and go right to multifamily, maybe something smaller, or I've seen people go right to 100 plus unit deals, 200 plus unit deals. But whatever you can believe that you can accomplish in your mind, because I think that's the first step, is that you actually have to believe that you can accomplish it. Go and do it and take action. And then, look, Michael thought he was going to be just building a portfolio of all single family homes, but at some point, he ended up coming in contact with these other people that educated him that he could scale more by going multifamily. But he probably wouldn't have ever done that had he not started, with the single family. So at some point, you got to take some action. The other thing that you said was, they're not smarter than you. I think that's important for the listeners too. Is I think in life we want to put people up on a pedestal that have success, and sometimes we put them up there and think that we're not worthy, and that's not But then when you surround yourself with them, you realize people are people. People are people, and you can do it too. Everybody started with nothing, no investments, and then they built one after the other. So, I want listeners to know that, look, just because we have, the Michael Beckers of the world on here that have owned 10,000 units, he started with one single family, and then built it from there. So talk about your latest show, because you just came out with a show on YouTube. What prompted that? How's that going? What's the focus? That sort of thing.
Yeah, so far so good. We started the Multifamily Investing Show with Michael Becker is what we're calling it. I know it's a real original name and everything, but kind of what I saw was a little bit of a void, and doing the old Capital podcast for, like I said, 6 years now, and it's great. Still going to do it, but it's we do it like on audio and just kind of on iTunes, and we kind of do it because we're both pretty busy guys, Paul and I, and now we're kind of bringing James in and helping out a little bit more just because we're so darn busy. I decided that I thought there was a little bit of a void in the marketplace with being an extremely highly produced show, so I do it in the studio. I actually record an episode today. That's why you see me wear a jacket, because I don't normally wear a sports coat unless I'm going into the studio or a funeral or something. But go to professional studio, record it. I'm really trying to go upstream, and there's a lot of shows out there that are great, and Old Capital, your show, and 1,000 other ones that are kind of along the line. So I thought I would just kind of be really highly produced, do video content, also release an audio form. I'm really trying to get some pretty high quality, high level guests where ownership groups that have done billions and billions of dollars in transactions, and the most prominent brokers and the markets across the country, obviously with the Texas bend, because that's where I'm in and where I play at. And that's kind of really who I talk with, and some chief economists. So I had Pat Jones on today from Austin, Newmarket, Austin. He sells $2 billion of apartments in Austin, San Antonio. It's probably number 2 in the marketplace down there. We've done a few deals with Pat, so it's been a pretty good show. So kind of thinking of it, if the Old Capital show is kind of like high school, this is kind of like graduate level. It's what I'm aiming for.
Yeah. So, well, first of all, the background studio looks fantastic. Look, if listeners, if you haven't seen it yet, you got to check out Michael Becker's show on YouTube. It looks like a very, very professional studio, like you would see a TV studio or a day talk show studio. I mean, it's really professionally done. And what's that?
What kind of
Oprah? Yeah. Well, the niche Oprah, right? So, and because, Michael has such experience, he's been involved in 50 some odd deals and 10,000, units. He has relationships with people that are just at high level people. So he can get those guests to come on and share their wisdom. So between Michael and his guests, there's a lot of wisdom to be had there. So definitely check that out. One of the other things that you talked about was, learning from others. And look, you've done 10,000 units, right? Like, some people may think I could never get there, and what else does Michael have to learn, right? But you are continually bringing people on that own $1 billion, dollars worth of assets, and you're learning from the next guy up, which, successful people, that's what I've seen them do time and time again. As they go to reach one goal, they're already setting their next goal.
Yeah, no doubt. I mean, I think a lot of it is kind of who you surround yourself with and aspirations. And I'm in my early 40s now, so I, can't just sit at home anymore. So still got to kind of try to go up, and do more and really kind of grow and scale. And that's, I was always a guy, Darin, that did a lot of deals just from kind of being the nature of my professional background. It's kind of always being a banker is very transactional. You used to do a lot of transactions. So we had that part kind of down. What's been kind of the interesting part of the last, 8 years or so of doing this is really kind of how do you take that and turn that into like a company and scale it. And then, I do a lot of stuff I really like to do, and I do a whole lot of stuff I don't like to do. Like for right now, we're in the middle of doing, it's tax season, so we're doing 1,300 and some odd K1s right now, and that's such a laborious process. You got to have systems and stay on top of all that stuff and team members and growing and scaling and dealing with 700 something unique investors, and it's just a lot. So that's been kind of the more interesting, not always fun, but more interesting side of the business is how do you become a company from just a guy doing some deals to an actual real company, and that's a lot of it. And that's kind of what I like to learn from the other people I talk to, especially in my space, and then talking with the brokers. I think a lot of the brokers in town and the markets I am, they're genuinely friends, and we hang out together, and we all kind of have common interests. So it's kind of good to stay abreast of what's going on the market, and it's a completely unfair business. A lot of this is who you know, what you know, and what chips you can trade, and things like that. And it's an imperfect market, and a lot of this data is if I know something that the next guy doesn't know, I got an edge. If I have this relationship that the next guy doesn't have, I have an edge. Or if I get this data first, I know this deal's out there and I can take action and recognize it's a deal and go quick and go hard at it. That's an edge. And, kind of what used to be my competition are kind of similar type firms to ours. And then now we're going buying bigger, nicer, better stuff. And, we're competing against some pretty heavy hitters, some institutions, that have $1 billion funds and stuff like that. So it's been kind of the evolution of that. And then how do you compete against someone that's got $1 billion of cash sitting in the bank account?
Sure.
Well, I'm nimble and they are not. And they have all these rules and committees, and I open my own money up, right? So I'm kind of like the cowboy out there, and they're all formal. And, it's a lot harder to deal with this institution that's got to check 1,000 boxes before they can commit to something. And I just go look at it, and we do our underwriting and our diligence, and I can get to a yes a hell of a lot quicker than they can. And that's kind of what I found as we're evolving in our business and doing different types of deals. That's a lot of kind of the interesting things over the last couple of years. It's cool to say we beat Related out. Related owns 70,000 units. We beat them out on a deal a couple of years ago, and they were all pissed. And then here's little me, and then we beat out 4 or 5 other names you would know in town on top of that on that deal. And I had a relationship, and I had done 2 other deals with the seller, got a great relationship with the broker. We ended up going hard and passing through some earnest money to do that. And Related can't do that. They got to check 1,000 boxes before they can go.
Yeah, that's huge. It's funny, as you're saying all that, I'm a small fry, and there's people that are smaller than me, and there's big guys like you, and then there's big guys that are above you. So, and you'll have some brokers talk to you, and hey, I've got this off market deal, I'm only showing it to you, and then I call somebody else about, hey, have you seen this deal? Would you, potentially want to partner if the numbers work out? Is it this deal? Yeah, I saw that last week.
Yeah, sure.
Right. So that partner saw it last week, and you saw it, 2 weeks ago, and passed. So it's funny how that works. But as you get more experience, and as you do more deals, and as you can be more nimble and have an edge, and make things easier for the broker, then you're more likely to get more of those calls earlier in the process.
Yeah, what I like to say about that is it's an off-market deal, you want to have the first call. And when it's a marketed deal, you want to have the last call, right? And that's kind of what I'm always positioning myself to get that first call on off-market deals. I have the first shot, and if I can react quickly, we can just kind of take it before the marketplace figures out what's going on. Or the last call, maybe I get that last piece of information saying, hey, if you do this, you pay this, you put this term in, it's your deal. That's what I'm always working to try to get myself in a position for.
That's a great point. Hey, another thing you said earlier was that you started out, your first deal was a 120 unit 1974 asset, and my understanding is that when you started out, you were doing BC assets, and everything I've seen you really do in the last couple of years has really been more on the A side, B plus to A. So can you talk to that kind of evolution? Like, why did you moved from that BC to the better quality assets?
Yeah, it's really kind of twofold. First, when we bought our first deal was, we needed to raise $1 million or $1.2 million, and had no idea how the hell I was going to raise $1 million or $1.2 million. And then, you triple your investors' money in 2 years a few times, and then your ability to track capital is a lot greater, right? And some of that's what we did, and we were, had a good business plan, and we executed pretty well. And then part of that's the market, right? I'm not so naive to think that I wasn't, certainly benefited by the times I live in and the city and state I've been doing business in. But something that's intentional too, because we took action and saw the market and thought it was a good time to enter. So, our ability to track capital is greater. So if I go try to put $1 million equity raise out, it doesn't make any sense because it'd be filled in no time. So we got to do a little bit larger transactions. That's one part of it. But really more than that, just the market's evolved so much. I mean, when I first started buying deals, Darin, like I said, I bought a 70s vintage deal for 30,000 units that now trades for 100,000 unit. And, at the time, you could buy a brand new Class A deal in Dallas for like a 5 cap. A B deal was like 6.5 cap, and a C deal was somewhere between 8 and 8.5. And you fast forward today, like an A deal is like, I used to say 4.5, a B deal is like 4.75, and a C deal is like a 5. But honestly, it's probably more like an A deal is like a 4, a B deal is like 4.25, and a C deal is like 4.5. Because the market rate, the cap rates have compressed so much because the interest rates and the debt terms are so much better today. And then, my show, your show, a million other things, lifestyles, the Sunrocks. I mean, there's so many mentoring clubs. So the interest within the space is just dramatically higher today than what it was just 8 years ago when I bought my first deal. So the market is completely different, and a lot more sophisticated than what it was back then. Even the unsophisticated money is so much more sophisticated than a lot of the semi-sophisticated money back 8-10 years ago. So it just doesn't make as much sense to me to pay the same or similar cap rate to buy something built in 1974 I can for something built in 2004 or 2014. And I get the workforce housing generally has you got a value add play, so you could go in and spend some money and spiff the rents up and drive your kind of your yield or your costs up a little bit just by doing some efforts over a year or two. So there's that play for sure. So I'm not trying to discount or say it's bad to do that. It doesn't make it for us. And then our ability, the bigger you do, like I said, it's unfair business. So the better the debt terms get, and then especially if you buy nicer stuff, the debt terms even get better. Because you have more options, where if you're buying something, a piece of crap property built in 1974, you got a bank loan and you got like Fannie Mae, and then you used to have some debt funds and they went away and maybe they're sort of back. Where if you could buy like a 2004 or 2014 vintage deal, you can have all various sorts of life insurance companies and all these different banks competing for this stuff, and they'll give you a little bit better debt terms. So the returns aren't that materially different for today versus if I went to go buy something. And honestly, I have a little bit less competition and some of those nicer stuff than I do. It's different competition, but it's a little bit less in scope. And I kind of figured out, like, you just got to be the cowboy when you're out there being aggressive and going after these deals to beat these institutions out. Or if I got to go bang it out and 20 other guys in the best and final on a 1970s vintage deal, I mean, that could get expensive as some of these numbers run from some of these stories I've been hearing. Like we had Al Silva, talked to him on the show. He mentioned a deal he sold, Fielder's Glen, and just how the price moved over $2 million in the process from like
Wow.
10% from kind of the initial offer to the ending, and it was just like a knife fight at the end. And I'm sure it was like a freaking 3 cap when it was all said and done by the time the price he got.
Right.
It's a difficult environment from a competition standpoint. So we're just trying to zig a little bit when others zag, and that's kind of where we're at right now.
That makes sense. And I've seen in the last, I don't know, probably the last year to 18 months, more and more syndicators as they're scaling up larger,
Yep.
kind of making that transition for the same reason as you mentioned, kind of ABC assets and cap rate spread used to be different, for the different asset classes. And now they're kind of almost on top of each other, so why not buy the better asset? But I saw you make that shift probably a year and a half before a lot of other syndicators started talking about that.
Yeah, we're a little early, and honestly, maybe I was a little too early because we bought all these deals at like 8.5 caps, and they all had 20+% upside on rents at the time, and a lot of these deals didn't have rubs in place, so you get another 10 or so % upside on your income just by billing back water and sewer and stuff like that. And then the 8.5 cap turned into a 6 cap. And we're like, we're going to triple our money. Let's go ahead and sell. And then I just didn't know it was going to go to like a 5 cap. Otherwise, we would have hung out a little bit longer. But
who would have thought?
I don't have too many regrets because if we didn't sell this one thing, we wouldn't have had the ability to buy the next thing and kind of so forth and so on. So it's it's never a static thing, because if I didn't do this, I wouldn't have done the other thing. So I think it all kind of worked out pretty well. But you're right. We kind of saw it a little bit early and kind of made that trade when I could sell a 70s deal for maybe 50 bips higher and a cap rate that I could buy a 2004 vintage deal. We kind of decided to take that trade 3-4 years ago.
Right. So talk about new construction, because I have not seen you get involved in new construction. Have you? And if you haven't, what? Development, ground up. For this kind of the same reasons you're mentioning. I'm hearing some syndicators get interested in. Not all of them have pulled the trigger on it, but have started to look at. Well, maybe it makes sense to build. Because I could build at almost the same price I could buy existing property for.
Yeah,
so, what's your take on that?
It's viable. Obviously, there these someone's built all the stuff that I'm out there buying at some point in time. So I think that's not a bad thought. What doesn't work or what has kept me away from it, let's put it that way. I don't know if it doesn't work, but I like buying a deal and getting a check like day one basically for income.
Right. The cash flow right away, right?
Yeah. And so the risk profile is a little bit different. So if you're going to go into a ground up development thing, there's a lot of people, especially when you're newer in the business, they don't really fully appreciate understand the concept of risk adjusted returns, because the risk profile, and if I go buy something that's 10 years old that I got $50 to $100 upside of rent by changing out some appliances or flooring or something like that, but it's 95% occupied the day I buy it, that's a completely different risk profile than me buying a piece of dirt in Prosper, Texas, where you live, and then getting the horizontal improvements, building it, leasing it up, stabilizing it, and have a 3-year window there. And if everything goes well, you should make more money if everything goes well. But there's a lot of variables that could come in and screw you up along the way. So that just really hasn't kind of fit into our current plan. So I don't necessarily have anything wrong with it. Just making sure if you're comparing a deal like what I do or what I believe you do to a ground up construction deal, if I'm showing a 14 IRR, my deal, you better be pushing 18 to 20 to make sure that risk is kind of you're rewarded. I wouldn't do a ground up construction deal for a 14 compared to a deal like my typical structure for a 14. That doesn't make sense to me, and I think that gets lost a lot with maybe a little bit less experienced investors, and but there's nothing wrong with it. I mean, it's just a lot of execution risk along the way and market risk along the way as well.
Right. I mean, the lumber costs jumped up dramatically in a matter of a few weeks. I mean, that you could build your whole plan, and then all of a sudden something like that throws a wrench in it. Hey, talk about this, because you got some people, and I have my view on it, and I'll share it, but I want to get your view. Dallas. So I'm an East Coast guy. I grew up in Connecticut. I lived in South Florida for like 14 years, and I've been in the Dallas market now for 11. And I love the Dallas market. I think, if I look at all major metropolitan markets across the country, I think the cost of living here is just dramatically lower than most other major metropolitan markets. But to your point, look, back in 2013, you were buying at 30K a door. You sold it, just under 60K, and then it was sold for 80K, and then, it's probably worth 100K now. Like, so some people ask me, well, Darin, man, how much further does this have to run? And so I don't have the crystal ball, but my viewpoint is some of the things that are helping not only Dallas, and Texas in general, but other, growth markets or population. More people are moving in from California, New York, Chicago, into Texas, into Arizona, into Florida, the Carolinas. And so with more population, there's more competition for apartments, more competition for residential homes, more competition for jobs, and more companies are moving into these markets, creating new jobs. So I guess my viewpoint is that there's still a huge gap in affordability between Dallas and, say, the coastal markets, California and New York. And I think over time that gap will squeeze. I don't think Dallas will ever be on top of California or New York in terms of, housing prices and rent and whatnot. But I think that gap, will continue to shrink. Another risk could be that, look, Texas has benefited from being able to have cash flow on these deals where you buy multifamily in California and, you've got two, 3 cap rates, but people are buying for the appreciation. Well, that could happen in these growth markets like Texas and, Arizona and other markets. So what's your view on those?
Yeah,
those
no, I think
topics?
those are all valid thoughts. I share a lot of them. I think the market is completely different. I lived here my entire life, and it was a sleepy town, and all the way up till probably 2011. Dallas is where you kind of came to go get yield. We had a lot of California money back kind of pre-Great Recession, so you sell a duplex in California and you go buy a 50-unit property in Fort Worth. Right? I don't know how many times.
That's good.
Over.
Right, that's crazy.
And so they quadruple their money or whatever in California, and then they go get an 8 or 9 cap deal in Fort Worth, and they go put 6% amortizing mortgage on it, and they clip 8-9% cash on cash, and they didn't expect to get a whole big pop on the back end of the deal, and then the market kind of shifted through the Great Recession, and we've seen a lot of we've already been kind of pretty big corporate relocation market for many years. That started well before 2010, but really kind of picked up and accelerated, and people started kind of seeing all the stuff that's going on here. So it's a lot more dynamic market. You lived through mostly good times here in your 11 years in town, but you were here in the early 2000s or the 90s or
Right.
early 90s. There was downtown. Everything else was sort of dead, but even downtown was sort of dead. Now there's all these vibrant nightlife places, and even you live out in the boonies, and even not too far from where you're at, you got Legacy West. That's like a second.
That's changed our world for sure.
Yeah, and you got these high-end steakhouses and all sorts of stuff there, right? So the market is completely different than what it was a decade or 40 years ago, whatever. So that's one part of it. But yeah, exactly what you're saying. So we're seeing corporate reloads, and a lot of that's kind of lack of regulatory burden, and more affordable way to do business and more affordable housing for employees of these people, for these large companies. It's really been kind of fueling a lot of the growth of the 4 major Texas markets in general. And then COVID's kind of accelerated a lot of that. And then in my time, the interest rates and I mean, hell, for the last since about 1983 when the 10-year Treasury peaked at 15 or 16 basis, or 15 or 16%, to today for the last 40 years has been a basically steady decline of interest rates. And that's why you see in the stock market and real estate and bonds. I mean, any of those kind of assets have all done really, really well. A lot of it's really kind of tied to the declination within the interest rates, and we're at historical lows right now, and or damn near. And it's been really, really great. And then so I think we got a lot of legs to it. And I think I'm not saying California's dead or New York's dead, because I'm sure they'll correct themselves and bounce back, and people will go back into Manhattan again when you go out to the restaurants and nightlifes and things like that. So it'll bounce back. But I mean, it's been I kind of think of it like the great economic migration. It's been happening for 20 years, and it probably brought you from the Northeast or South Florida to Texas was probably a job. Right. I'm assuming. I don't know that to be true, but you probably had a job.
Well, my wife's family was here, so it was the wife kept telling me move to Dallas. I had started a company a year or two prior to that, trading loan portfolios, and I could do it anywhere. So I made the shift, and I was actually the first one in my family to fall in love with it. I love it here.
Yeah, and then you got that. Then the two markets I'm in too is Dallas. I mean Dallas and Austin, and I know the stats in Dallas much better, but the last I heard two stats. So we just had a changeover of the decade a year ago, and from 2010 through the end of 2019, that 10-year period, Dallas-Fort Worth grew by I think 1.2 million people, and the projections were at the time from between 2020 and 2030 basically is going to grow by like 1.35 million people more. So I mean we have like a 6.7 million population base or something like that here. I'm sorry, $7.6 million person population base, something like that. So in the next decade, give or take, we're going to overtake Chicago. And I think that is probably going to accelerate even faster with COVID and the whole migration. And if you look at like Austin, on a percentage basis, Austin's growing even faster. Austin's like crossed over 2 million people in 2015. I think it's about 2.35, 2.4 million people today, 6 years later. And it's just staggering to see the growth down there. And people ask me to kind of compare and contrast those two markets all the time. That's what we're in. So talking to investors, I think of Dallas. I like both markets a lot. But people move to Dallas because they get a job. People move to Austin because they want to be in Austin. And then now all these tech jobs and things like there. And I was like I said, talking to the broker from Austin today. I mean the pricing has just gone parabolic. I mean, it just like 3.5 caps. Like everything's like a 3.5 cap. Like 80s deals are all trading. And well-located 80s deals are in the 150,000+ unit range. 2005, 6. That's like 30,000-40,000 a door, right? So I mean, you're talking almost quadrupling the price of some of this stuff. I mean, it's just unbelievable. And then there's just so much money flooding in to those two markets in particular, and to much lesser extent Houston and San Antonio. That I don't see what stops it, to be honest with you. I mean, if we see that kind of population growth, you talked about lumber going up, concrete, labor, you get regulations, you get a $15 minimum wage. I mean, all that stuff is just going to make everything more expensive. So sure. I mean, where are you going to hide? I mean, I think it's a world of bad options if you want to invest. You got to take risks to get any sort of yield. I mean, there's no way to hide out with no risk and get yield, because you're going to get 50 bips on your checking account, and you're going to get a 10-year Treasury at 120 as a 120 bips. 1.2% as we record this. So if you want to go produce, 5-6% yield, you got to take some level of risk. And I think all things being equal, the multifamily space and Florida, Arizona, Texas, Carolinas, Georgia, the kind of the Sun Belt markets, I think those are pretty good risk-adjusted returns. If you want to speculate, take a little bit more risk, honestly, maybe you go buy Manhattan, because the cap rate in Manhattan right now is higher than, say, a generic suburban Dallas deal, and that should not be the case, right? When has that ever been the case? Right. I think that might be, and that's a function of the market being screwed up, but you would think at some point that will flip back, and maybe you want to be countercyclical, you go buy Manhattan or downtown San Francisco if you can stomach that up and go pull a deal off.
Right, absolutely. I'd love to hear your take on this, because people ask me this. I'll share my view and love to get yours. People ask me, okay, Darin, not for the people that are in the multifamily world, that are in these multifamily mentorship groups, but just, personal contacts. They want to get in, they're into investing in this, but they don't really fully understand it. And so they'll ask, hey, Darin, what's your view on the biggest risk in these deals. And so to your point, I have not been through, a downturn, the workout scenarios where everybody's in trouble from the real estate side. But I've been in the loan trading side since 2002, trading residential, multifamily, and commercial real estate loans. And, I say to people, in my view, the biggest risk in these multifamily deals is the loan term. And the reason for that is some people will get bridge loans, 3 years with 2 1-year extensions, and sometimes those work out great. The longest loans you can get are agency loans, 10, 12-year fixed rate loans. And then, banks like to try to keep it with a 5-year duration. And my point is that I saw people get in trouble on the loan side when their loan came due in a terrible economy. You go into recession and your loan comes due, your cash flow is down, cap rates go up, your property is now not worth what you paid for it, so they ask for more equity. And if you don't have the equity, then they take your property.
Yep.
So what's your take?
That's certainly a risk. I mean, I think the greatest risk is probably the sponsor in my mind. So you invest with a crook, someone that's going to steal your money, or you invest with someone that's incompetent. Those are two. I guess crook would be worse than incompetent, but like fraud sometimes hard to protect against. So making sure you understand who you're getting in business with, and then secondarily, if the sponsor, is kind of a lot of these people look at the deal and kind of look at the pro forma and the returns they're going to get. They don't think about like the depth of the sponsor's experience and the depth of the sponsor's ability to feed some of these deals. And so I think that's certainly a risk. I mean, Mike Hardage, our mutual friend Mike Hardage. We interviewed him on the Old Capital podcast a month ago maybe, and he was talking about how he had just a disaster of a deal down in Port Arthur, Texas. It was, fire and a hurricane and flood, and had a bad loan on it, had a bad partner, and Mike's reasonably well healed, and throughout it all, he was just writing checks. And then at the end of the day, he got all his investors' money back, and then they all broke even. And that was like, you hear the horror story of that deal. If Mike wasn't there, that would have been a lot worse than just getting your money back over 4 years. So, and to testament, if he put a deal out, I would seriously consider getting in with a guy like that, because I've seen, him kind of get tested in a difficult time. So, if you're investing with these sponsors that have, 2 nickels to rub together and throw one of them in the deal, who's going to be there to write that check? Because in my experience through the downturn, some of the issues we had when some of these syndicated deals, when we had recourse loans on at the bank, we had the sponsor wouldn't put very much, zero to little money in these deals, but he would sign the loan personal guarantee on our mortgage, and then the passive investor would put a lot of money on it, but they wouldn't sign the note. And then when stuff hit the fan and you had an office building and half it goes vacant, sponsor's like, I'm not going to throw good money after bad. And then the investor's like, I don't have any recourse, so I'm not going to put any money in it. So like we as a bank were kind of stuck holding the bag. So that'd be it. One thought on that. And then the other thought to the debt, I'm not necessarily opposed to taking short-term bridge loans, but I think when I look at it, I think you think about the maturity risk, and is because that's a real thing. Because a lot of these people that had loans with me had a loan maturity in 2009, and the capital markets were frozen, and they were just screwed. And as you eloquently just said, they had an 80% loan to value. The properties were $10 million, and in the current time when your loan matures in 2009, maybe it's worth $8 million. You got an $8 million loan, so the bank playbook is like remargin my loan, pay me down to 80%, and then you have the whole cash call issue I just kind of mentioned to you. So that got these guys in trouble. They had to go sell at a bad time because the bank couldn't extend their mortgage. So I think if you're going to take a bridge loan, don't do 85% leverage. I've seen a lot of these guys that are through 2009. We sold a deal to somebody, and they put an 85, I think 83 or 84% bridge loan on it with a debt fund, and just absolutely leveraged it to the perfect hilt. And I had to get $120 rent bumps, and we were selling it because we were like hitting the ceiling, and I couldn't push past it. So I was like, well, let's go ahead and sell it. And they bought it and put this bridge loan on it and closed in the latter part of 2019. And I was just like, how the hell are they going to get out of this thing? And so I'm sure they've had some pain. I mean, I don't know that to be true, but they had to have had
Right.
some pain because I'm sure that elevated collection issues, and then their lender, especially you get with this type of lender and you're fully leveraged, and then they have like these lockbox. Then they start springing in the lockbox and stripping all your cash, and then you're having a hard time operating, or they refuse to fund your capital draws, so you go out and spend $100,000, and then you can't pay all your vendors. So if we're gonna we've done some bridge loans, and we'll typically just lower the leverage. We'll get 65% or something like that, and just lower the leverage. So then if there is a hiccup, I got a little better margin of error. Or if I want to go higher leverage, we'll tend to put a 10-year loan on it, right? So I think you need to think about it. If you take a little more leverage risk, maybe have a little less maturity risk. If you take a little bit of maturity risk, take a little bit of risk with your leverage. Lower your risk.
Yeah, it's a great point. And most people that I've seen don't do that and don't think that way. If they go bridge, they're like, that's great because now I could take, they'll throw in my rehab costs too, and I could get 85% leverage. And so you're thinking of it like, hey, if I do bridge, for the listener's benefit, the advantage of doing a shorter duration loan is that your prepayment penalty is going to be substantially lower.
Yep.
So if you do a longer term loan, then a lot of people get stuck because they could sell the property for a profit, but a lot of their profit is going to be eaten up by prepayment penalty. So if you do a shorter duration loan, shorter term loan, then you have a smaller prepayment penalty. But you mitigate that risk by having lower leverage. I think the other piece that can come into play is where are you in the economic cycle? If you think that you're near the end of the real estate cycle and you could be hitting a recession, then there's probably more risk with that. And if you're coming out of a downturn and you're going into a growth phase, then you may have lower risk by doing a bridge loan and being able to turn the property around in a shorter time frame.
Yeah, and that like I said, that a lot of these lessons I learned on someone else's nickel because I was the Grim Reaper on the opposite end of the deal, and for sure to your prepayment penalty and your yield maintenance penalty. I had a conversation on one of our deals today because I got a really good offer, but we still have a very large prepay penalty, and it's just like, no, we're not going to sell. We made a mistake when we put this 12-year loan on it, and we're going to ride this sucker out because I'm not going to give $7 million of our profit away. I'm just going to just kind of play prevent defense here, or kill the clock, ball control defense, just kill the clock and let this thing kind of burn down, and then we'll get paid in the future. I'm not gonna take it on the chin today. And I've made that mistake tens and tens of millions of dollars over in my career. So that's been one of the single biggest mistakes. So I'm not opposed to fixed rates anymore. We do a lot of floating, so I'm not opposed to fixed rates, but I'm starting to get very allergic to yield maintenance or defeasance. So trying to find an alternative way, and watch those debt funds. I mean, they're starting to come back a little bit. And it's great because you can get a little leverage and you can juice your IRR and you can attract some capital that way. But nothing in this world's free. So there's a certain level of an underlying risk that if everything goes to plan, that's great and you're gonna make more money. But if it doesn't, you're gonna get yourself in a spot where you can be in trouble pretty darn quick.
Absolutely. So talk about where do you find most of your equity investors? So you mentioned you have you're doing all these K1s. You've got 700 individual investors. I've also seen on a number of your deals, I don't know if you do it on all your deals, but that you selectively pick one, it appears at least, that you selectively pick one large partner that also helps, raise capital. And so I'm guessing that, you have your bucket and you're bringing from your database, and then you partner with somebody strategic, and then they have their bucket and they, bring in a piece as well. Is that kind of how it works for you?
We've done a couple things. So we really kind of say three ways. I would say we kind of look at it. One, we started out, and then we do this from time to time. Is we'll joint venture with like a one-off high net worth individual, typically out of California. Got a little connection out of Minnesota that's got a couple guys that way as well. So the story typically is I sold a building in California. I want to come to Texas. I want to do a 1031. I don't know anybody. Help me get home on my 1031. So we'll form a joint venture, formally through like a tenant in common agreement or a TIC. And then they put the bulk of the money up. We put a little bit of money up, and then the compensation gets shifted from carried interest, kind of your typical carried interest structure, or you promote the deal where you get percentage of the profits of the deal by doing the sweat equity. That gets converted into like a fee income based model where you get acquisition fee, you add like a disposition fee, and typically add a higher asset management fee. Because that's what is required to become compliant with the 1031 rules of the TIC. So that's a smaller part of our business, but we have kind of that little niche, and I have 5-6 guys I've done that on dozen deals over the years. So I'm in the middle of one of those right now. So we've got a really, really good niche that we kind of fell into. The other way we do is we typically just have a pretty big database of our own. I have a couple thousand people in the database, many hundreds that have actually invested with us that are on my list. And that started out with just kind of friends and family and talking and, people I knew kind of professionally, and then started the podcast. So I get a couple, 3 people a week off the shows that'll kind of just reach out every week. And so that's kind of helpful to build up the list over time. Then referrals, especially if you do well for somebody, they're always telling their buddy about all the good deals they do. They never talk about the bad deals, but they always talk about the good deals. So you have a couple of good deals, you'll tend to get some referrals that way. And then from time, once in a while, we've partnered like with 2 separate people over a handful of deals where we're like, if we want to do like a really large deal, we'll find the deal, and then we partner with someone that's got a really big database. And so we'll kind of joint venture the deal, kind of split up the compensation, and then everyone we bring some capital in, they bring some capital in, and we kind of do the deal. And so we've done it that way. And that's been a way to kind of scale up. What I have not done is taken like institutional money. I've kind of just made it a choice to avoid that for many, many reasons, but control being kind of the biggest one. I don't want some 25-year-old MBA kind of telling me what I can and can't do. I want to kind of be the captain of my own ship and control the deal. So that's been, that would have been probably a little faster way to scale up, because you get a program put in place and they give you 90% of the money, and it's got to worry about 10% of the money. You kind of repeat it, but nothing in this world's free. There's some non-monetary cost to all that stuff.
Right. Absolutely. So you've accomplished so much, man. You're a leader, and I applaud you, because I've talked to so many people that have, know you, and you have kept, you've just made yourself available to help other people. And, although you've had a ton of success, I don't know you that well, but the reputation that I hear is that your head hasn't ballooned, that you actually still love to help people. And I think that that's awesome. And that's one of the things I love about this space, is that people above, they are typically willing to help the next guy, come up, and then you're looking to get to the next level. So that's fantastic. What's the next big stretch goal for you?
I don't know if we have a stretch goal. I've thought about it that way. I mean, we want to do, 250, 300 million in transactions this year. It's kind of the 2021 goal. We got our first deal done Tuesday, a couple days ago as we record this, and I got another one closing in the month. So it's, we'll get, about 45 out of the gate by the end of close of February of 2021. So it'll be a good start to the year, and then go from there. We're working on a big exchange for one of our kind of repeat 1031 guys. So hoping to go buy a big pretty new thing somewhere in Dallas or Austin. That's kind of what we're looking at right now, and kind of more. We're kind of in the process of just signed a new lease to expand my office space. And we're hiring a couple of new people and trying to grow and expand and do more, and launching the show and trying to kind of build up our own database a little bit even bigger, and maybe you get away from joint venturing from time to time with some of the partners we just mentioned, and really just kind of do everything in house and really kind of grow and scale. But along the way, we got some really good partners that have a lot of synergies with us. So there's no complaints really on my end. So just kind of the future's up, and I want to keep going. And I think the market that we're in, and we're going to expand to another markets. We're actively thinking that San Antonio is finally a good time to enter the market. A lot of people that go to San Antonio, and sometimes it's kind of where promotes go to die, at least last few years. And I think that is a good time to in the market because the supply is way down, and I think the fundamentals aren't quite out of whack. It's not nearly as dynamic as Dallas or Austin. Certainly Austin, which is
Right.
this stepsister, hour and a half up I-35. So Austin is certainly the sexier of the two, but I mean, pricing is, you get a material pricing break if you go to San Antonio. So I think the fundamentals at this moment in time, as we talk right now, is finally attractive for us to consider going there, in particular on the more Class A, kind of AA minus space. I don't know if I want to go play in the workforce housing space down there per se in San Antonio, but that's kind of on my horizon. And if that doesn't work out well, we really probably do need to find a third market at this point. We've been kind of slow and measured, with what we do, and I think it's probably time to get another market, and as we continue to grow and scale. So yeah, I'm just excited. I think you always hear I heard a poem once. I don't know if you ever heard of a gentleman named Jason Hartman. He's got a very popular show and podcast I listen to, and it was a poem from the 70s called "The Reluctant Investor's Lament," and it's basically about some guy in the 70s talking about all the deals he couldn't buy, and he missed them because he thought everything was overpriced, and back then, and he thought everything was overpriced, and that was 45, 50 years ago, and everyone thinks everything's overpriced, but if you can buy on fundamentals and make these deals make sense, I mean, you're buying in a growth market like the markets that we're in right now, or many other markets across the country, I think fit that bill. And you're prudent and strategic, and you buy at what I think is a relative value to current market. These things kind of tend to work themselves out, and we're in a space where the government's encouraging it, where the Fed is saying they're going to keep interest rates lower for longer. And if you ever try to short a stock in the last 12 months, you can see how hard it is to fight the Fed.
Holy
hard
cow.
to fight the Fed. I think we
hard
got
to fight the Fed.
I think we're in a super cycle, and we have been in it for a decade. I think we got a decade or two ahead of us in the Dallas-Fort Worth and Austin markets in particular that I focus on.
That's huge. That's huge to hear. And to your point, when I got involved,
my entire net worth in this stuff, I either have cash or I got apartments. I don't really do a whole lot in between. So, maybe I'll go down with the ship here at some point in time, but I'm certainly a true believer of it, and we're going to do more. So excited about it, and glad you have a show that kind of flies a flag. I think it's great for the average person to get at least some level of exposure into this space and kind of get the money out of Wall Street and get with real stuff that actually has fundamental business principles behind it, like a apartment does, versus trying to go buy some Bitcoin or Tesla stock or something like that.
Right, exactly. So, look, outside of work, what do you do for fun?
I used to like to travel when that was a thing. So I think again, so looking forward to a lot of places I want to go. So looking forward to, got to as a kid, we grew up with, we weren't poor, but it was relatively modest means. And so I think I was on an airplane once or twice before I turned, 20 years old. So always in the car going somewhere versus flying. So didn't get to go to Europe until recently. So I'm a little upset that COVID took out a Europe trip and a Hawaii trip last year that we had kind of planned, and it ruined both of them. So looking forward to going. Actually, going to go to Hawaii for spring break with the family. So gonna suck it up and go out there, and looking forward to hopefully go to Europe and travel and kind of go explore the world and expand my horizons a little bit. Because growing up in Carrollton, Texas, and having blue collar parents, you didn't have the biggest worldly view. So trying to make sure that I can provide that to my kids and experience it myself. Because I'm tired of sitting at home. I'm ready to go.
Right. I think we're all itching to get out there, right? So, well, Michael, I appreciate you coming on. If people want to reach out to you, what's the best way for them to reach out to you?
I'll give two resources. Again, the show you referenced earlier, which I appreciate the nice words about, is the Multifamily Investing with Michael Becker. YouTube's probably the best place. It's also on iTunes or Stitcher or anywhere you're hearing my voice right now. Hopefully you can find my show there as well. Or the URL is www.multifamilyinvestingshow.com. The company I run is SPI Advisory, so you can go to our website, which is www.spiadvisory.com. That's SPI like spy. On there, there's a contact form. You fill that out. We're always happy to send out information if you're interested in learning a little bit more about what we do.
Look, the listeners, I mean, this guy, I was listening to him before I got into the space, and he is just a wealth of information. he's been through it, man. He's been through 50 deals. So he has a ton of experience, and I believe he's going to be here for the long, long term. So I look forward to learning more from him. Definitely reach out to him. Definitely check out his show. And I hope you guys enjoyed that one. Until next week, signing off.
Thank you for watching Darin Batchelder's Real Estate Investing Show. If you liked the episode, please click the like button and subscribe to the show. If you already are subscribed, then thank you, and please share the show with a friend. Check out other free resources at darinbatchelder.com/learn.